Assalamualaikum and a very good day. My name is NURUL binti AZMANI with the matrix number 2512433936 and I'm one of the representatives for Group 8. Now I'm going to explain about the introduction, features of oligopoly, number of firms, nature of the products, barriers to entry and exit, control over price and also information availability. Firstly, introduction. Market structure reflects the patterns in price movements such as support and resistance levels or highs and lows, which traders use to make profitable decisions. These trends persist through specific phases and directions until momentum shifts. Shell is a global energy leader that operates across this market, engaging in activities from oil exploration and refining to power generation and trading. Features of oligopoly. In an oligopoly, a few dominant firms control the market, protected by high barriers to entry like startup costs. These firms are interdependent, meaning prices stay rigid as competitors react to any changes. A concept shown by the kinked demand curve. While the market is often inefficient, high profits allow these few players to control pricing and invest in long-term innovation. Number of firms. In an oligopoly, a few large firms like Shell and Petronas dominate the market. While no single company has total control, they are highly interdependent. This means each firm holds significant influence but must carefully anticipate how competitors will react to any changes in pricing or strategy. Nature of products. Oligopolies feature similar products differentiated by branding rather than function. In the petrol industry, firms like Shell use premium fuels like V-Power and additive to build loyalty. These strategies create a competitive edge even though the core products are close substitutes. Barriers to entry and exit. High barriers like massive capital, advanced technology, and strict licensing make it nearly impossible for new firms to enter the oil and gas industry. Established giants like Shell also benefit from economies of scale, maintaining lower costs that smaller competitions cannot match. For control over price, firms like Shell are price setters but remain constrained by government regulations and competitor actions. To avoid price wars, Shell focuses on non-price competitions like service quality and loyalty programs, rather than aggressive price cuts to maintain its market standing. Information availability. Information is imperfect, creating an asymmetry where firms know more about production and quality than consumers do. Since buyers rely on brand perception, Shell uses heavy advertising and branding to bridge this gap and influence purchasing decisions.
In an oligopoly, the demand curve is kinked because competitors only follow price cuts, not price increase. This means demand is elastic when prices rise but inelastic when they fall. Consequently, firms like Shell often fail to achieve economic efficiency. They are productively inefficient because they don't produce at the minimum average cost, and allocatively inefficient because price remains higher than marginal cost, as shown in the diagram. These firms prioritize profit maximization over ideal efficiency levels. Shell is a prime example of an oligopoly in Malaysia's fuel industry, where only a few large firms dominate the market. It operates in a high-barrier environment characterized by clear product differentiation and strong interdependence. Because there are so few competitors, Shell cannot act alone. It must closely monitor the pricing and business moves of its rivals before making any significant decisions. This constant need to watch competitors is a hallmark of the oligopolistic structure Shell has operated in since 1910. Shell's behavior is defined by its interdependence with a few dominant rivals, requiring constant monitoring of their prices and products. While Shell leverages a massive network and economies of scale as core strength, it faces significant hurdles like regulated price ceiling and high capital costs. Currently, the company's biggest challenge is navigating the global energy transition while managing these operational expenses. Essentially, Shell must balance its market leadership with the pressure of a highly regulated and shifting energy landscape. To conclude, Shell faces critical challenges. primarily government price controls that limit its profit margins and the inherent risk of a collision within an oligopoly. Operationally, the company must manage high environmental costs while navigating the massive shift towards renewable energy. This transition is Shell's biggest long-term hurdle, requiring a total evolution of their business model to stay relevant as the world moves away from fossil fuels. In conclusion, Shell's position in the full oligopoly shows how dominant firms compete through branding and innovation rather than just price. While this market structure is not perfectly efficient, the combination of government regulation and Shell's focus on the customer experience helps balance corporate competitiveness with consumer protection. Ultimately, Shell's ability to adapt through continuous innovation remains the key to its long-term survival in this complex market.